Ladies and gentlemen, welcome to the study. Going to be talking about the power of options and how I like to make my money trading options. And before we proceed any further, I would like to state that the information in this video is not a recommendation to buy or sell any securities and is for educational purposes only. With that being said, let's get to options trading. Options trading has become so popular nowadays, especially from many new time investors and traders being stuck indoors all day from the pandemic, looking at their computer screens, charts, all that stuff. It has created a bigger community more so than ever. This is exciting. This is great for the community of traders, but I don't think it's for everyone, especially since options trading comes with so many risks versus simple individual investing into stocks of certain companies. And behind every options trade, you want to make sure you have a thesis or some sort of rationale, very much like owning a stock in an individual company, right? And since we're talking options, you have to be extra careful here because options are derivative assets that are based on the underlying asset. In other words, they are a function that is based off of the individual stock that you are trading on these options. Therefore, it carries a very high degree of risk. There are many factors to consider as well that are at play when looking at options, such as delta, theta, implied volatility. There's a lot of terms. I'm not going to be covering all of that in this video. I just want to be talking about specifically an example here with NFLX trading options. And the most important thing I would say is that you really need to be aware of option pricing, and that can be tricky, but without considering all of those Greeks that I just mentioned before, some of you may be familiar with those terms. I will say that the number one thing to look out for when managing options or trying to trade options is be aware of the pricing. Be aware that you're not getting ripped off and that you are getting a good deal on your options contract. You want to make sure you're getting a good deal because since options are decaying assets that have an expiration, whereas stocks don't have an expiration date, you don't have to worry about that. And I want to give an example here with NFLX, kind of showing how I utilize options in events and try to protect some of my long-term holdings that I am long on. And so when we look at NFLX that I have pulled up here, this is the stock on the bottom, and this is a specific options contract, which you could see that has rocketed up in value in a day. And then on the left here, I have the SPY ETF, the SPY, which is a general market indicator of the S&P 500. And what happened is that NFLX had earnings after hours, as you could see on this big drop candle here. This was on Thursday, January 20th, 2022, which you could see. It produced a dramatic response. The report from the earnings triggered selling in combination with a market that just hasn't been so hot so far into this year, 2022. We've been trading in the red. We've only had about 3 green days, I think, if you look at this S&P, the SPY chart I have here. And what I like to consider when I'm looking at options before I make a move is the environment and sentiment that we are in. And in this example, it is quite negative or bearish. When you zoom in for the month of January 2022, we have just been massively going down from a high on the SPY, $479 to $437. It is a big drop, correction territory, so it is very bearish. And this is an indicator that is going to tell me that sentiment is negative and that the bears are out to get the bulls. So if the SPY is trading up, there is positive sentiment. If there is a negative sentiment in the market, you would see something like this, a clear downtrend on the technicals and just volume pouring in. Notice how these volume candles are just trending upwards. So that is a big indicator of that we are in a bearish market and seeing red and sentiment is down. Second, I like to do is knowing the recent news that is taking place. This is very important because since there's so much news and events that can have an impact on the financial markets, from Twitter tweets to global crisis, supply chain shortages that we are seeing playing right now with the virus at play, and elections do have influence as well, not just elections in the US, global elections as well. And so you have to take those things into consideration. So right now, everybody's worried about this market that we're in. It's very dramatic sell-off that is taking place for the start of 2022, and that's a hot news headline to consider. So you have the chart telling you something, and you have all these headlines in play. Lastly, I like to, and this is the final component, there's a bunch of ways you could go about setting this up, but these are the 3 simple steps I like to approach when looking at these options trades that I want to utilize to turn a small sum of money into a large sum. And that would be just looking at upcoming earnings seasons, or any earnings reports that are going to be out. And this is a pretty cool tip that I could share with you on the thinkorswim desktop application here that I have on thinkorswim. You could see the expected move from the market on earnings for a specific stock, and this is how the options chain is priced. So if you go here, and you can see this is the options chain from today. Dramatic sell-off. As you can see, Netflix went down $110, about negative 21.7%. And if we go to analyze and we look back at here, this is October 20th, 2021. So this is actually the previous earnings I have pulled up here. And it's a very good idea to look at the historical performance on these previous earnings. You could see that they were pricing in about a $9.39 move to the upside or downside. This is what the market is pricing in on this earnings report. Same company. You can do this. You could go back and look at that's very a powerful tool that thinkorswim provides, where you can get a better idea on how a stock moves during these earnings reports. And you could see that the stock actually moved down $13.86. It actually moved more than what the market was pricing in. Therefore, the puts actually appreciated more. And you're going to see a very similar pattern here on the most recent earnings. When we change this to January, here we go, 2022. And here we go. They were pricing in, well, it's not showing up now, but they were pricing in a $40 move. I'm not sure why it's not showing. Oh, wait, I have to put the previous. There you go. Right after market, they reported their earnings. The stock was at 508 with 25. And you have the market pricing in a $40 move to the upside and a negative $40 move to the downside. And you can see this is quite a wide range, and that the options chain had a lot of activity. When you go here, you could see that these options contracts, I can actually show you something even better. If we go to this table here, I have the net change column enabled for these puts, and you can see that they dramatically increased off of this massive drop. The idea here is, depending on your budget, your balance, and what I mean by your balance is your account balance, the equity that you have in your account. Everybody has a different financial situation and a different amount of stocks and dollar amounts invested. and their savings, all of that. So depending on the scope, you want to make sure that you're putting just a small amount of money risking into these derivatives and turning that small amount of money kind of like insurance policy. And when the insurance, hits the fan, you get paid on that policy. And it's kind of the same approach with this options trade. We have the 420 strike. This is the one I was looking at specifically. And you go here and guess what? You have the 420. You go here. We're going to pull it up on the chart. You can see it increased today, $27.10. And actually I have it pulled up right here. You can see that the low was 75 cents the day before. And if we maximize this and zoom in on the the 5-minute, 5-day, about $5. That's funny. The 5-minute here, you could see that the stock was just hovering between this 0.75 and $1. And then at the end of the day, it actually shot up to $2. And then the bell happened, closing bell, and the value of all these options contracts went up since the stock price dropped so much. The idea here is that you could have put, just a single contract down for maybe 90 cents or $1, which would equate to 100 shares on the contract, right? So $90 to $100. And looking at the performance of this contract, you could have cashed it out just right at the open. Honestly, like $30, or write it up on the further push down, which is what happened on the stock. If we open up and zoom here, you can see that the stock on open dipped further down to a low of $379.99, which caused the premiums on all these options contracts to shoot up. And you look at this and you just essentially turned $100 into $3,000 or $4,000 if you decided to ride this contract for a bit. And since it's a short dated contract, I like to just take the profit. I got my insurance, it landed. Hey, I'm good. Now I can do something else with that money. So let's go over here and let's show the option chain again. Now, what I want you to do is I want you to look at the 500 to the 420. Just look at the prices and look at the net change here. And you're going to notice a pattern. When you're looking at the pattern here, as the price goes down, you're going to notice that the change isn't the net change isn't as much. And the reason for that is because of this huge drop. Remember, when the stock price goes under the strike price, these contracts are considered in the money. And since you have such a huge drop that happened in the stock, so if you got the 480s, for example, and these, you could do the math right here, going for 86 minus 72. So you were looking at paying maybe like 14 to 16 bucks on this contract, which would have been $1,600 in total. And it went up to 86 because you were getting that dollar for dollar move. Every dollar down, individual dollar is going to add an individual dollar value to that contract. So it's in the money. It's like a bonus that just keeps adding on. And that's the beauty of, if you have more capital to risk, then you can target those contracts that are closer to in the money. If you have a smaller amount of money that you want to risk, go for the ones that are further out. Now remember, these severe drops are not going to be common. You have to take things into consideration, and we will review the 3 steps I just went over right now, kind of considering those things. So 1, right, we're doing the recap. Check the overall market outlook sentiment, and look, and we go back here. Look at the SPY. This thing is crashing down from the sky. 2nd, check for any news or events. okay, the market is crashing down from the sky. Everybody's freaking out. The CNBC guys are freaking out. Your friends on your Discord or your Messenger WhatsApp group are all freaking out. Boom. Lastly, earnings. Look at these earnings, then maybe there's a play and a chance that you could take advantage of an opportunity there, and check the historical price of the options and check what the market is pricing. Without adding any more length or details to this video, I just want to leave it on that simplified note. I really like this example with Netflix, how we were able to use a down negative sentiment market to our advantage as a hedge with this put trade, and just turn a small sum of cash into a nice large sum of cash. That's what options trading is all about, especially when you are the buyer throwing a little bit of money and making that little bit of money work extremely hard for you, so you can use that large sum of money for your retirement account or for another investment, or maybe you want to take a quick vacation trip, So, guys, if you enjoyed this video, make sure to leave a like and subscribe for more content. You can visit me at thetradestudy.com, and I will see you in the next one.